is Idris Dales, and my partner is Brian Shepardly. And the company we decided to do is Nike. The company that we decided to analyze is a very well-known, successful company that caters to millions of people around the world. Nike Incorporated is an American multinational corporation that is engaged in the design, development, manufacturing, and worldwide marketing and selling of footwear, apparel, equipment, accessories, and services. In order to analyze the company, we plan to look at the company's basic ratios and comparing them to previous years and like companies in their industry. But looking at some of these factors, we hope to build a greater understanding on whether it is a good time to invest in the company. The company is doing well, but that the stock price is already quite high relative to its value, or that the company is doing rather poorly and we should not purchase at this time. We think it's best to begin by observing how the company's basic ratios are currently holding up and trending compared to the previous years, as well as to other companies within the industry that it operates in. One of the first things that an investor would look at in order to determine whether a company is worth investing in would be an equation that tests profitability. An equation that does a great job of doing so would be the return on asset equation. This equation shows the percentage of how profitable a company's assets are in generating revenue. Nike's return on assets is 14.5%. This equation and determining it is a good or not usually is based on what industry it is in. In the industry that Nike is in, a lower yield is expected because their assets are what run their company, but a higher number is encouraged. Other companies in the industry like Adidas, which has a 7% yield, and Under Armour, who has a 10.3% yield, are also major competitors of Nike. The reason Nike has a higher yield is most likely because they have been more successful than their competitors, therefore driving up the net income, yielding the higher return on asset. What also must be looked at is how Nike has done in the previous years. In 2014, 2013, and 2012, there is no more than 1% change in the ROA, which would be comforting to an investor. Another important equation comes from measuring parts of a company's liquidity. The current ratio is a financial ratio that measures whether or not a firm has enough resources to pay its debts over the next 12 months. It compares to a firm's current assets to its current liabilities. Nike has a current ratio of 2.72. Given that any number under 1 may show that a company may have difficulty meeting obligations, Nike is doing well. Close behind Nike is Under Armour with a current ratio of 2.65%, and then Adidas tailing at 1.45. Over the past 3 years, Nike's current ratio has been up and down, being all the way up to 3.44 in 2013 and back down to 3.05 in 2012. This change most recently happened due to an increase in accounts payable. Next is the company's debt-to-equity ratio. The debt-to-equity ratio is a financial ratio indicating the relative proportion of shareholders' equity and debt used to finance a company's assets. Nike currently has a debt-to-equity ratio of 72%, while it's surrounded by its competitors with Adidas at 92% and Under Armour at 50%. A high debt-to-equity ratio generally means that a company has been aggressive in financing its growth in debt. Nike has a very reasonable percentage for a company in this industry. In 2012, Nike had a debt-to-equity ratio of 49% and 58% in 2013. So it depends on what the current year's strategies are for financing its growth with debt. Lastly, we wanted to look at a very important market test by using the price-earnings ratio. The PE ratio is an equity valuation multiple. It is defined as market price per share divided by annual earnings per share. The current PE ratio for Nike is 27.33. PE ratio is a fundamental measure used by long-term investors. Traders and other short-term investors do not typically use these factors. They base their trades on momentum and other technical factors. So given that Adidas has a PE ratio of 21.42 and Under Armour has one of 74.11, each different investor may look at the numbers differently. Our job, based on our research and opinion, is to conclude that it is a good time to invest in Nike. Like Nike is doing well, but the stock price is already quite high relative to its value, or that Nike is doing rather poorly and should not be purchased at this time. Based on all the numbers that we have crunched, Nike is leading its industry throughout many different areas and continues to appear a front runner. Nike has been trending the right way over the past few years, which is attractive to an investor. Also, pros to buying the stock are the established brand name. They are actually being innovative and recent growth in shopping. The cons of the company are the presence they have in manufacturing in China. Also, Nike has a forward P ratio of 27.33 compared to Adidas forward P of 21.42. For example, there is a slowdown, which could easily happen in China or Europe. The stock would be vulnerable. Besides, the dividend is a meager 1.4%. In the end, we came to the conclusion that it is fairly priced at best in the short run, but the pros could be restricted, so we would not buy the stock because there may not be much more growth to Nike in the coming years.